In the next 30 days, millions face a hidden 401k retirement trap that could drain thousands from your savings if you're not prepared. Average 401k balances have surged past $150,000 thanks to market gains and auto enrollment. But experts warn this growth brings costly tax and Medicare risks. Many retirees become retirement rich but cash poor, forced into large required withdrawals that spike taxes by thousands and could slash your Medicare benefits. Diversifying across Roth, taxable, and pretax accounts is the key to flexibility, letting you control withdrawals and potentially save $3,000 or more annually in taxes. Here's where it gets interesting. By adjusting your 401k strategy now, you can protect your retirement cash flow and avoid costly surprises after age 72. High 401k balances mean larger required minimum distributions starting at age 73, potentially pushing you into higher tax brackets and increasing Medicare premiums sharply. Financial advisor Suze Orman warns that failing to plan for these tax hits could cost retirees tens of thousands in unexpected bills starting in 2027. Here's where it gets interesting. Balancing Roth conversions now can reduce future tax burdens and protect your savings from these costly withdrawals. The IRS sets strict rules for required minimum distributions, and ignoring them can trigger penalties up to 50% of the amount missed, as highlighted by IRS Commissioner Danny Werfel. Investment giant Vanguard recommends reviewing your withdrawal strategy annually to avoid surprises that could drain $10,000 or more from your retirement income each year. Large 401k balances can trigger Medicare premium surcharges starting at $107 per month, directly hitting your retirement healthcare costs starting in 2026. Financial expert Greg McBride from Bankrate warns that ignoring tax planning on big 401ks can cost retirees thousands annually in unexpected taxes. Fidelity Investments highlights that splitting savings between Roth and taxable accounts can reduce your tax burden by up to $4,000 annually during retirement. Here's where it gets interesting. Failing to diversify your retirement accounts could force you to withdraw $15,000 more in taxes each year starting at age 72. The IRS requires minimum distributions from 401ks starting at age 72, a rule that impacts millions and can spike your taxable income unexpectedly. Financial advisor Gregory Hutchison from Maryland warns that even with a $1 million 401k, unexpected taxes and expenses can drain your savings faster than you expect. Here is where it gets interesting. Market volatility in 2026 means your $200,000 retirement portfolio could lose 15% in months, threatening your planned income stream. Fidelity Investments highlights that without a flexible withdrawal strategy, retirees with large 401ks risk paying $10,000 or more extra in taxes annually starting age 72. Greg McBride from Bankrate points out that failing to plan for Medicare premium surcharges could cost you an extra $3,600 a year out of your retirement income. The deadline to adjust your retirement tax strategy is closer than you think. Protect your savings now by reviewing account types and withdrawal timing immediately. Financial planner Barbara A. Friedberg warns that ignoring tax-efficient withdrawal sequencing can cost you thousands in unnecessary taxes each year during retirement. The town of Snow Hill, Maryland, where retiree Gregory Hutchison downsized, illustrates how relocating can reduce living expenses by nearly $12,000 annually for many retirees. Here is where it gets interesting. Market downturns can slash your 401 value by 20% or more, forcing larger withdrawals that spike your tax bill unexpectedly. Financial author and CPA Tom Wheelwright stresses that strategic Roth conversions before required minimum distributions can save you up to $5,000 in taxes annually. The IRS building in Washington, D.C. reminds us the tax code is complex and ever-changing, making professional advice essential to protect your retirement savings. Large 401k balances can unexpectedly push retirees into higher tax brackets, increasing your tax bill by thousands annually without proper planning. But here is the catch. Those bigger withdrawals also raise your Medicare Part B and D premiums, potentially adding $3,000 or more to your yearly healthcare costs. This is what the media isn't telling you. Failing to coordinate your withdrawals across different account types can cost you tens of thousands over retirement. Here's what you should do first. Consult a tax pro to map out a withdrawal plan, minimizing taxes and Medicare penalties starting this year. And keep watching. Next month, we'll reveal the top 3 moves to protect your savings from tax traps and rising Medicare costs in 2026. Big 401 balances can push you into higher tax brackets unexpectedly, costing you thousands more each year. This tax hit shrinks your retirement spending power fast. If this saved you even one bad financial decision, hit subscribe. Your future self will thank you. Drop a comment. What's your biggest money worry right now?